Welcome to Adulting, Rent to Retirement, the video podcast where three professionals and friends try to make sense of this whole being an adult thing.
We will talk about real life adulting topics, finances, home ownership, and legalese, and all the things they didn't teach us in school.
Whether you're renting or buying, investing for the future, planning for your family, or just trying to keep plants alive, we've got you.
You can expect laughs, real talk, and some pretty useful advice from a real estate broker, financial advisor, and estate planning attorney.
Because adulting can be hard,
but at least we can figure it out together.
Let's get into it.
Welcome to Adulting, Rent to Retirement, a podcast where we explore real life adulting topics. I'm one of your co-hosts, Katrina Hofstetter, and today we're going to dive into a financial topic that I think many people have questions about, which is setting up an emergency fund. Joining me are my co-hosts, Ashley Smith. She's a realtor and broker with Oasis Realty, and Dan Malcolm, a financial planner with Sequent Planning. I know Ashley has clients that are buying and selling, and when they're working through that process, I think it's probably common that emergency funds are going to come into play there. And I also work with clients through the estate planning process where we talk about assets, and emergency funds are going to come up during that conversation. So I think this is a topic that all three of us can relate to. And I will turn the mic over to our financial expert and my co-host, Dan Malcolm. And why don't we just start with, Dan, what is an emergency fund? What's the purpose of it?
So first off, thank you, Katrina. And I would like to point out that my background is not fake. The ladies told me that it looks fake, and I can definitely see what they mean because, it does. But this is my real yard, and I'm outside. It's Friday, and it's beautiful, and I've been waiting for it to be beautiful. So what is an emergency fund? In its simplest terms, an emergency fund is 3 to 6 months, ideally 6 months worth of fixed expenses. And we'll kind of cover some of this a little bit later, but when people think of 6 months worth of fixed expenses, sometimes that can be a pretty large number. And so an emergency fund is sometimes a goal. And even if you only have 1 month of emergency or fund, like 1 month of fixed expenses, that's better than zero.
Yeah.
And so that's in a nutshell, is an emergency fund is there for when emergencies happen. It's money that needs to be liquid, that's not going up and down in value. You can get to it easily, fast, quickly. And if the car breaks down or the washer breaks down or like me today, I discovered that I really need to hire a professional to come put in my dryer vent because Stanley Steamer guys were here earlier and did duct cleaning, and they did my dryer vent as well. And which I really assembled hillbilly style, and we got an awful lot of lint out of there, and there should not have been that much lint.
That was a great story.
So my emergency fund might one of these days be used to, I don't know, supplement the insurance money when my house burns down because I've got so much lint in my dryer vent.
So Dan, what do you categorize as fixed expenses? Because we're talking about covering our monthly bills, those fixed expenses for 3 to 6 months, but also the emergency is usually something else that comes up. So what do you consider those fixed expenses?
So the fixed expenses are going to be anything that you need to live. So your mortgage, your rent, if you have a car payment, your car insurance, food, basic needs. It's not going to include things that some of us think we need, like streaming services, the most expensive, latest, greatest phone, and so that's a good segue into the next thing of how do I calculate my emergency fund.
Yeah.
So with my clients, what I do, the very first step to figuring out how much my emergency fund should be is figuring out how much my fixed expenses are. And so I go through a cash flow analysis, and I use that like fun $5 word or whatever, because people don't like the word budgeting anymore. But a cash flow analysis is basically just budgeting.
Yeah.
And I try to share with my clients and help them adopt the vision that I have in regard to budgeting. And that is, a budget is not meant to like ruin my life. It's really meant for me to take control of my finances and for me to be telling my money where it should go and what it should do, rather than my money telling me where I should go and what I should do. And so I have a brainstorming worksheet that I use with people that want to do that. And I've been assembling the worksheet for about 5 years now. It started out, it was just the worksheet that I used for my own home budget. And when I meet with people, anytime they surprise me with something, I add it to the list. And so it's become a pretty exhaustive list. And it makes it really fast and easy, and sometimes fun, because some of us, will laugh at what other people include in their budget that we don't. Like the lingerie line item. I did not. I would have just included that in clothing, but I was at somebody's house and they said, "Well, buying lingerie once a month is very important to me," and I was like, "All right, then we should probably have a lingerie line." And so we put that on there, and I left it so that if anybody else wasn't thinking about that as far as like just a regular clothing budget, and I know that's kind of a weird example, but the goal there is to really, really like drive down into the nitty gritty of your finances. Maybe take a look at the debit cards statement, look at the credit card statement, and really get a feel for where is my money going. And then at the end of it, we total that all up, compare it to our income. Do we have a surplus? Do we have a deficit? And then are we comfortable with where the money is going? And that's not my, no judgment there. Some people are very comfortable with money going places that I wouldn't be comfortable with my money going, and vice versa. It's just a matter of having control of it. And that's where we would get the idea of the total fixed expenses would be from that.
I have a question on fixed expenses. What about, I know you talked about things we absolutely need, like housing and utilities and food, versus things like streaming that we don't need. What about debt? What about credit cards? Like if we are in an emergency situation, is paying the credit cards important, or like letting them lapse? Should the emergency fund cover those payments?
That's a good question, Ashley. I include at least the minimum payment on the credit cards in that amount, because we don't want those. What we definitely don't want to happen is something happens, you're needing to use the emergency fund to live off of for maybe 3 months. You lose a job or something like that. We don't want to miss those minimum payments on those credit cards and then have that be spiraling out of control on us. And so that when we get to the end of the 3 months, we've got a job again, we can back up, take a breath. Then we've got this, crisis of credit card debt. So yeah, I would include the minimum payments in the emergency fund. Ideally, we, as a part of setting up the emergency fund goal, we're going to deal with debt, bad debt at least. And so in an ideal situation, if you've hit your emergency fund goal, that means we don't have credit card debt.
Yeah.
Okay. Awesome. Thank you.
I have a similar question, like whether or not these types of expenses, I feel like they don't fall into the fixed expense category, but I'm thinking about like our whole budget and like the things that we allocate every month. And we have expenses that are like annual expenses, like vacations or Christmas, birthdays. And we try to budget every month to like push money into separate accounts for those things. But those are also like extra things. Like a vacation is not, you're not going to be taking a vacation if you're don't have a job and you're digging into the emergency fund. But would that be more of like a second tier? Like if you hit all of your fixed expenses and you meet your emergency fund goal for those, then you could beef it up more to help cover things like annual vacations and birthdays and Christmas and stuff, would you still include that?
So that's also an excellent question, an excellent point. So when going through the budgeting exercise, the budgeting brainstorming exercise, we are also going to um, brainstorm those things that come like once a year, like birthdays, Christmas,
Right.
those things. I even get down to the point of like car maintenance. So
Yeah.
you've got 3 cars. Do you think you get 2 oil changes a year in those 3 cars? And so, all right, we've got 6 oil changes a year. And so now car maintenance, I guess part of your question is no, I wouldn't necessarily include vacations, Christmas fund, birthday funds, even car maintenance to a certain extent, like oil changes. Your car can go, over on an oil change if it needs to for a few months. So I wouldn't necessarily, at least at first, include those in the fixed expenses. I've just got to keep myself alive, fed, sheltered,
Mhm.
and the family relatively happy. But once you hit that goal, now, I guess I have 2 things to say there. Once you hit that emergency fund goal, then yes, creating other sub accounts within your budget for vacations, Christmas, birthdays, and such is an excellent idea. And I'm really, really impressed with how many, I don't see it so much from banks, but a lot of credit unions that my clients use, they allow them to create little like sub accounts. And that's really great. And you can set it up for automatic, I won't get into the weeds on that. But so that's part of the answer is like, yes, being as detailed with your money as possible is great. The other thing I would say though is, shoot, what was it? Oh, everybody's different too. So if I have a client who say their emergency fund goal is $30,000, because that'd be $5,000 a month. So 6 months, that's 30 grand. So it's not unusual to see a number like that. And we're sitting down and they've got $20,000, but they really, really they're planning on buying a house. Then we may pivot to, all right, the money we're saving now is for a down payment. In the case of an emergency, we could always take the down payment money and use it, but we've got this other goal. We've got a nice big lump sum here to handle, 4 months worth of fixed expenses. So we can pivot to another goal. So the whole thing can be very customizable to each individual person.
Yeah. I just thought of something. We're all business owners and our businesses have expenses. And some of those expenses, at least for me, like I'm a W-2 employee, and so is Ryan. And so I almost wonder, for someone in my situation, do I need to be building the emergency fund only at the business level? So for instance, I've got like everything that flows down from the business is what covers our expenses personally. That's our income. But then there are some other business expenses that are going to come from the business that if business slowed down, we would want to have an emergency fund. So I wonder, does it make more sense to build the emergency fund at the business level because it trickles down and covers us personally?
I would build one for business and one for personal.
Okay. But then the business one wouldn't cover our income because we're covering that at the personal level.
Correct.
Okay.
Yeah, good distinction too. Great distinction.
Okay.
And that also is going to depend a little bit on how you're structured too.
Sure.
So like in my case, in your case, your business pays you as a W-2.
Yep.
My business does not pay me as a W-2.
Yeah.
And so my emergency fund is also kind of my business emergency fund. They're very intermingled.
Yep. Okay, that's good to know.
So something else that people ask me is, where should I have my emergency fund?
Yeah.
If I'm going to have this like large $20,000 to $30,000 lump sum of money, I hate to just have it sitting in even my high yield savings account, because it's just
you put it in your mattress, right?
Right. My gold bar.
You want it to be liquid. Yes.
You buy gold bars, silver coins, and coffee cans in the
Coffee
backyard.
can in the backyard. I was
Yes.
just gonna say that. Good old Folgers.
Best emergency plan I've ever heard. Um, so, the bank, generally speaking, is not paying great interest rates. They're paying better interest rates right now. As of today, this is being taped on May 29th, 2026. I forgot I was going to say this at the beginning of my spiel. None of this is intended to be individual investment advice. And also, this is based on information in May of 2026. So right now, banks are paying higher interest rates than they have in the last 20 years. Eventually, they will probably start going back down. So right now, the simplest answer I give to where should my emergency fund be is it really should be about half of it, maybe 25% of it in just a regular savings account, even though we're really bummed about the interest rate we're getting. The other 50 to 75%, depending on which split you want to go with, CDs at the bank right now. CDs are still paying a healthy interest rate. Right now, I would suggest going longer in term, even though you might have to take, you might not get your interest rate on a 36 month might be a little shorter than your interest rate on a 12 month, or a little less than on a 12 month. I would go for the 36 month because rates are likely going to go down. That's why the bank is paying more for shorter. They expect them to go down as well. So sorry, I'm getting in the weeds on that. It's hard for me not to geek out on this stuff. But we want to, the best way to capitalize or make money on our money at the bank is through CDs. And most institutions right now do not have an additional penalty for taking the money out of the CD early,
Oh, okay.
other than just you may forfeit interest. So not every bank and credit union is that way. So if you're going to do this plan, you should ask your banker, credit union, or your credit union, if I have to take this out early, is there an additional penalty, or do I just forfeit interest? If you're only forfeiting interest, then there's not a ton of risk there because you're not going to make a ton of interest in your regular account anyway.
Right.
Does that make sense?
Yeah.
Absolutely.
Now,
Go ahead, Katrina.
I was just going to ask about, like, I know there's some online banks right now, like Ally and I don't know, other names that have come up that I think are newer, that seem to have higher interest rates than like our local banks and credit unions. But are those still, as far as you know, are those still not as good as what we could get in a CD?
So the devil's in the details there. They will, well, all banks, whether they're local or they're online, oftentimes, especially for their whether they call it a high yield savings account or an insured money market account or a Saver Plus builder, whatever name they want to give, they will oftentimes have tiers. And so if you have in this account, if you have 10,000 to 20,000, you get this interest rate, all the way up to, maybe it tops out at, I've got $100,000 in this account, so I'm going to earn this. This is the most I can ever earn. They will often advertise that highest rate. Even though that's not really going to apply to most people. So when evaluating where to put it, first of all, getting with your local financial advisor and talking it through, whether it's me or somebody else, is a good idea. But then also just looking at, what are the bands, the interest bands, and generally all banks and credit unions are so close that I wouldn't put a ton of time into it. I put some time, but I wouldn't put a ton of time where I'm like trying to pull up 50 institutions and like really get in, maybe 3 or 4, and then just pick the best one. First National Bank of America in East Lansing, generally speaking, has really strong rates.
That's where Dan told me to put my emergency fund.
Their First National's hometown checking account is I love that account.
That's that's what we use too. Dan, I do have a question though, because I'm really smart and financially savvy and don't need a financial advisor like yourself. I don't really understand why I need an emergency fund because I have credit cards and I have a 401k I can withdraw from. So why would I need an emergency fund when I can just charge it on my card?
So the first is credit cards are they are nice. Um, and and
They're
I'm not
nice.
and I don't go as far as Dave Ramsey and telling everybody that you should never have a credit card and you should only use cash or debit cards. Um, because in the real world there just are situations in which a credit card makes sense. Um, and but as you know, the downside to credit cards is if it's an emergency and you don't have the emergency fund, if you're not able to cover it out of your regular income, then you're not going to be able to pay the credit card back fast enough. And you're
Yeah.
going to eventually end up with high interest rate accounts. Um, and you can play the 0% balance transfer game with credit cards a few times for a while. And I do encourage my clients to do that sometimes, especially if I'm coming into a situation in the middle of we've got 3 credit cards and they're 20% interest and whatnot. All right, well, let's at least stop the bleeding of the interest.
Yeah.
And what was you have your credit cards and what was the other?
I'm just gonna
401k.
take it out of
Oh,
my 401k.
yeah. When you are the answer to that, Ashley, is when you are 70, do you want to cash a check or fill out a Walmart application, job app?
I definitely don't want to fill out the Walmart application.
So
Oh,
borrowing from your 401k, borrowing from it or taking a distribution from it, withdrawal from it. The younger you are, the harder that hurts you for the future.
okay.
So
And I know you said borrowing versus doing withdraw, just to make sure I understand that correctly. If you do a withdrawal, there's penalty to it, correct? Typically. And but some 401ks do allow you to borrow the money, which may seem like a good idea because you're not getting those penalties, but you're saying that that's also going to hurt me on my retirement as well.
Yes,
Okay.
either way, and that is a good distinction, though, Ashley. Yes, if you whether it's a 401k or an IRA, any type of retirement account, if you take the money, you actually take the money out, then yes, not only will you probably have a taxable event, but you're also going to pay the 10% early withdrawal penalty if you're prior to age 59 and a half. 401ks do allow loans, or I should say most 401. I feel like all of them. I've never encountered one that doesn't, but I should never say all or whatever. Probably keep my compliance person happy. Most 401k plans allow for a loan provision. So if you have to, however, IRAs do not. You can't take a loan against your IRA. So if you are having to make it like the emergency is dire enough that you have to tap into your 401k funds, the loan is better than a withdrawal.
Yeah. Ashley, your question made me think of another question. And then Dan, you commented about Dave Ramsey and they kind of go together. So
The
if
snowball.
I know,
The Dave Ramsey
so
snowball.
if I'm in the mode of, okay, I'm only going to focus on building up my emergency fund. Should I not, are you of the opinion, which Dave Ramsey is, that you shouldn't contribute? Or I feel like maybe he has said don't give up the match. I don't know. So
Hmm.
do I stop contributing and also miss out on the matching for a short period of time in order to better facilitate filling up my emergency fund? And I know Dave Ramsey has an opinion on it and I can't remember which way it goes. What's your opinion?
Yeah, so I'm relatively sure last I knew his opinion is don't give up the match, but
Okay.
maybe don't contribute as much, get out of debt faster.
Okay.
So my opinion is this. So Dave Ramsey says a lot of great things, but he's also talking to a very large audience, and so he's not
Yeah.
able to give individuals, tailor-made, customized advice.
Yep.
And so the long answer is it really the devil's in the details again. It depends on the individual situation, but generally speaking, I say you pay yourself first. with the exception of maybe credit card debt. Credit card debt is so, well, gosh, uh, nobody wants to default on debt, but you have the ability. There are some debts that you can default on, and they don't have a ton of recourse on you other than messing up your credit score. You can't default on your retirement. You're going to get old. You're going to get to a point where you don't want to or you can't work. And so um, your retirement doesn't care what your credit score is. And so you always want to just be really trying to pay yourself first and then pay everybody else after that. And for people of faith, you want to pay God first with your tithe,
Yep.
and then you want to pay yourself first, second, and then everybody else after that. But there are, I mean, last week I was in an appointment with a client, and I encouraged him to turn off his 401k contribution for 3 months. But it is on his calendar, it is on my calendar. 3 months is it. We're going to turn it off for 3 months, and we have a strategy that we want to use that money for. But
Right.
whether we accomplish the goal or not, we're turning it back on in 3 months.
So I just want to say, like, Dan, you are our family's financial advisor, and so maybe I have a little bit more experience with this, with working with you. I know we've thrown some questions at you that you're like, that's a tricky one because it could go either way. But one thing I think that has been really helpful, is you sitting down with us and looking at like, what makes the most sense of for our individual family of building the emergency fund or paying off the credit card debt first because it's got 29% interest, or should we be putting it into our IRA, which yielded like 10% interest last year? And you do a really great job of breaking all that down for us and telling us based on the interest rates and based on what we have and based on the bills we need to pay, what should be priority. So I wanted to say that I think it's in my opinion it's really important to actually you can get all the advice you want from Dave Ramsey or from our super cool podcast, because I used to swear by the Dave Ramsey snowball method and having the $1,000 and like, but I think I have learned so much and I'm in such a better financial situation by actually sitting down with somebody that looked at like what our family's financial situation is and what makes sense for us based
Mhm.
on what we have, because you can say, oh, it's fine to pay off the smallest credit card first, not the higher interest rate one, which is what Dave Ramsey says. But when you look at numbers of this credit card has 8% interest and this one is 29, like that's insane. Why would you pay that one first? So
Yeah.
I feel like it really helps to sit down one-on-one with somebody to do that. And I just wanted to give you that shout out that I appreciate that about you.
Well, thank you. I really appreciate that. And I'm glad you said that because I want to mention something. Um, so I do a lot of like budgeting and consultation work and just chats with people, financial chats with people for free. And most advisors do. There are some advisory firms these days that are charging like an hourly rate to sit down with somebody and like work out a budget or work out a retirement plan. And those firms are getting paid whether you choose to use their retirement plan or not, or whether it works. And there are firms that are charging like membership fees. So if you pay this much in your membership, then you get to sit down with your advisor for this many hours a month or whatever. And it's like buying access. Don't use those firms. Just don't. That eventually, I hope eventually that will be illegal because in my opinion, it's predatory and it's terrible. And they should be ashamed of themselves. And so, find an advisor, whether they're a fee-based fiduciary like me or not. Find an advisor that will sit down and talk with you for free. That will do it for a cup of coffee.
Right.
Yeah, absolutely. That is great advice because there are so many, I think, especially as you get older and things, technology changes and stuff to easily get scammed by thinking that you need to pay for a service. I mean, this happens in real estate all the time too. Banks, or you get letters once you buy a house that's like, pay us a fee to split your mortgage payment in
Yep.
half each month and it'll save you money in the long run. You could literally do that yourself, but
Yeah.
you get that letter in the mail and you think, oh my gosh, I should definitely pay somebody $100 a month to do that for me. So
Yeah.
I really appreciate that you, mentioned that and provide that service for your clients to help them figure out a plan without charging them to do that.
Dan, before we close out, I think the last question that's on my mind is like, if we've worked towards setting up an emergency fund and we meet that goal, and maybe it's like the big goal, we hit the 6 months and it's everything, it's all of our fixed stuff, but all the extra stuff, then what? Like what should we have a new goal? What do we do?
That is an excellent question. We throw a huge party. You take me to Vegas and we blow it all in one weekend. Just kidding.
I love
Um,
it. I'm in.
Horrible advice.
um, that's my strategy for getting to go to Vegas several times a year for free. No, excellent question. And so once we've hit our emergency fund goal, then we are definitely going to turn our attention towards those what I call midterm money goals, things that we may want to accomplish in like 6 years from now to age 59 and a half, sometime between 6 years and when we want to retire. So we're probably going to create that vacation sub account if that's one of the goals. We're going to look at how are we funding our long-term bucket, so our retirement plan. And so if we've been having to just contribute to max out our match at work while we were getting our emergency fund in place, then it's time to ratchet up our long-term saving. If our long-term is fine, then we need to ratchet up our midterm saving. And if our long-term and midterm are fine, then maybe we have some short-term goals that are not emergencies. I want to buy a boat next year, not an emergency, but also I want it next year if possible, not 6 years from now.
Yeah. That makes sense.
Once you have, especially if you get to the 6 month goal, once you have that in place, like in a way, the world is your oyster. It takes so much stress away from like your life and your marriage. It's an emergency fund is so healthy for marriages, and I'm big on marriage and happy people.
Yeah.
It's true. He tried to trick my husband into marrying me. Um, long story. We'll tell it another time. Uh, I had a question and I forgot what it was because um
Because I
talked about
wowed you with
that.
my answer.
You did. You did.
Yeah.
Nothing else needs to
It
be
just
said.
knocked your socks off.
Well, hopefully it'll come to me one day and we can bring it up on another episode. Oh, goodness. Should have wrote it down.
You ladies are great.
And that's a wrap on this episode of Adulting Rent to Retirement.
Thanks for hanging out with us. We hope you've learned something, laughed a little, and feel slightly more prepared to adult today.
If you like what you heard, be sure to subscribe, leave a review, and share this podcast with a friend who needs this in their life.
If you have questions for us or topics you would like us to cover, hit us up. We love hearing from you.
And don't forget to join us next time for more real talk, bad jokes, and actually useful advice.
Until then, keep adulting, or at least pretend to.